Today, folks, we're diving down into Canadian monthly paying dividend ETFs that kind of relate to what I've been looking at with these guaranteed investment certificates, GICs. We're going to be taking a look at some of these high interest savings accounts because I personally started utilizing them for my emergency fund. And then we're going to dive down into my over 330K stock portfolio, everything from my TFSA to my corporate account in full transparency. If that is a conversation you can appreciate, in return, I simply ask you to hit that like button because I'm going to show you in this new environment how I'm kind of utilizing all of the tools that are basically being presented to us, with first and foremost being the high interest savings account here, folks. I'm using Scotiabank, and I've noticed that month over month, the high interest periods are getting very nice. Currently on a 90-day, you can get about 1.7%, which, keep in mind, that would be over the whole year, but it would be calculated over that 90 days. And the 360-day savings account, which again, you can pull money in and out of these at any point in time. You just lose the premium period, which will show you what that looks like in the actual account in a sec. But at 1.85%, you're better just locking it up for the 90 days so you can constantly reset it every 90 days, presuming the interest rate will be a little bit higher. So that's what I'm actually doing, is I dump $10,000 into the 90-day. And this is just a segment of my emergency fund, but we can see you're going to earn this regular interest rate of 0.85%. But if I leave it in here for the full period, I'm going to get 1.7%, which is just super awesome, right? So I'm going to kind of keep you updated and continue to monitor this, but kind of in this endeavor of looking for these guaranteed returns, because on 10 grand, 1.7%, 170 bucks over the year. Yeah, it's not great, but it's not terrible either. But we can come into GICs, which are similar to bonds, but it's nuts that if I lock money up for 3 years, keep in mind, this is a locked up, I can't withdraw period, I can get 4.2%. This is why they're speculating gold is crashing, the precious metals, commodities are crashing, because you can get like insanely good returns off these guaranteed investments, right? But what led me down the rabbit hole of these monthly paying dividend ETFs is basically the fact that they can get 10% up to 50% with a market-linked GIC based off the Scotiabank Canadian Utility ETF. And I was kind of just digging through these utility ETFs, and they are pretty marvelous if you wanted cash flow today, because they are monthly paying, like the iShares S&P TSX Capped Utility Index, which the return obviously doesn't come anywhere near close to the S&P 500. But just taking a look, guys, the expense ratio a little higher at 0.5, 0.61%, but with 3.2% starting dividend yield brings that down closer to probably 2.6, 2.7% after the fees. And the holdings in this one specifically make up Fortis, Brookfield Infrastructure, Emera, Algonquin Power and Utility Corp, Hydro One. This is probably my favorite. The ticker on this is XUT. It does a good job of increasing the dividend, and again, just paying it monthly. I do not like how concentrated it is, with the top 10 holdings making up 87%, but it is a very passive way to get monthly cash flow. There's also the BMO Equal Weight Utility Index. Now, personally, I don't like this one as much. The ticker ZUT here, folks. Primarily, first and foremost, it does pay about a 0.10% higher dividend yield, same expense ratio. It is much more diversified, which is a much better, a tribute to an ETF if you're looking for safety and security. But just because it doesn't increase the dividend as much as XUT has, and I like the top weighted holdings in XUT a little more, even though they're concentrated, I would probably pick that preferably. But comparing this to a US counterpart like the Vanguard Utility Index Fund that does not pay a monthly yield, is up 103% in the comparable time frame, doing much better. And when we take a look, guys, the expense ratio is basically null. It's at like 0.1%. The yield is slightly lower, but again, if you knock off the fact of how high the expense ratios are on the other ETFs, you're still actually going to end up with a little bit more. And then on top of that, guys, much more diversified with these huge market cap US utilities, just to kind of give you a comparable from the US and Canadian side of the border. But that is what the GICs in Scotiabank are currently linked to, is some of these utility ETFs that have been much more stable during these volatile periods. But taking a look at my own portfolio, my monthly holding, or my monthly paying ETFs, and just my S&P ETFs, guys, I have been getting some juicy dividend yields. First and foremost, in my tax-free savings account, I have about $821, all converted to CAD, with about $445 being US. And I should point out right now, guys, that the Canadian dollar has been falling to the US dollar this year. So most of my money right now is actually sitting in US dollars, which is working to my favor, because basically it's been in there for over several months, and the Canadian dollar is now down 5% in comparison. So if I decide to convert it back to CAD, I'll actually make 5%, which is very nice because it plays largely into my favor. But taking a look, guys, VYM, VOO, I ain't making money on a single thing in this account. I am not making a single dime in any one of these accounts since I converted all this stuff over, but it is streamlining my life, and I'm looking to probably continue parking these dividends in the S&P 500 index. But if you're looking for monthly Canadian income, VDY is definitely the way to go. But taking a look at my managed account, again, this account has been sitting null. I haven't done too much with it. Again, down on Smart Centers, down on VDY. I got about 120 in dividends that have been paid out that I might start looking to add capital here, maybe even add one new REIT. I feel like I'm underexposed to the real estate sector, and I've been very eyeballing Northwest Health Properties that pays 6.5% right now. I haven't pulled the plug on it yet. I wonder if you guys have done deep dives on it. What do you think about the Northwest Health Properties, another monthly paying Canadian REIT, which I absolutely love, but haven't pulled the trigger on just yet. Taking a look at my RRSP, again, these have been relatively null. They go down a lot because the S&P, the index is all dropped, but it's been flatlining for the last, couple weeks here. But taking a look down on these positions like VYM, VOO, again, more dividends in here. Not probably going to do too much until that builds up. Finally, my corporate account, I got a lot of dividends in here because I have a huge position in VDY, which I'm down 7% on, but almost $50,000 position in there, guys. And we can see that this account has been trailing to the downside, worth about $77,000. As of this very moment, it looks like it's down about 8.4%, and that's because I probably was buying VYM and VOO toward the higher spectrum, down about 10% on each of these, which I will continue to probably cost average into as time kind of goes on. But as the market kind of evolves here, trying to take a strategic, more guaranteed, stabilized return, a lot of investors are turning to bonds, GICs, and to be honest, it's probably not the worst thing you can be doing right now. If the interest rate continues to go higher, it's something that I'm going to be heavily eyeballing. If we start seeing that approach closer to 5-6%, then yeah, I'll probably take another $5,000-$10,000, lock it up in a guaranteed investment, and then just kind of collect that cash flow as well. Now, just to bring this into a full scope and kind of bring all the accounts together here, we can see that by country, my portfolio exposure is 63% the US, which is something I wouldn't have been as much in favor for, but because the Canadian dollar is dropping and comparable, that's probably, again, working to my favor, with about 35% coming from Canada. Now, by holding here, we can see that the S&P 500 is 35%, the Vanguard Investment Canadian, the VDY, the income ETF here, guys, is 28%, and then finally the VYM, the US dividend ETF, is about 24%. And then we can see we've got a couple of the REITs, my crypto exposure there. And if we just go back to the dollar amount itself and just kind of take a look at buy holding, again, huge cash position, still just, accumulating some cash, always putting that aside. But again, Royal Bank and the financials right now still make up the largest sector of this portfolio. So I'm hoping by just continuing to buy into the S&P 500 that it will continue to larger weight my information and technology. I would like a little bit more tech exposure. And then again, as I add REITs, perhaps one of these utility ETFs, which I'm kind of on the edge with because utilities are only 4.4% of my sector exposure. And to be honest, I think the best sectors, if you're looking for income, would be financials, utilities, REITs, and healthcare. I mean, if you build a portfolio of those four sectors alone, you get great yields, great reliability. But again, you kind of want to get that growth in there for somebody at my age. So kind of making sure I have information and technology is probably going to be pretty prudent at this point. I should also mention that I am still buying Bitcoin pretty regularly. Nothing crazy, but that should be something that's noted. I don't talk about it as much just because I know how many people are losing money because they don't know what they're doing. If you want to get into Bitcoin, if you want free Bitcoin, I do have an affiliate link with Shakepay that luckily is a platform in Canada that hasn't gone under, that has been very reliable. I'm not going to get too much into it, but you can check all the links in the description below. But on that note, I want to pass the question off to you guys. Lots of different ways and lots of different tools that are now coming into play in the financial markets, whether you're talking guaranteed investment certificates that yield over 4 to 5%, or just, again, looking for stability coming out of these monthly paying dividend ETFs. I'd love to know what you think about all of this in that comment section below, and consider subscribing because as time goes on, I've always been transparent on this channel with all my buys and sells, and I will continue to be moving forward. So again, consider subscribing, but stay cool, stay awesome, and as always, I look forward to catching you in the next one.